Well, the months are flying by and we're seeing the market performance on the JSE not being particularly advantageous to long-term investors. Well, Steinhoff directors in April facing angry shareholders at the AGM. It's the first AGM since the retailer's accounting scandal broke. And directors laid out key plans to try and resuscitate and rebuild and recreate and restore confidence in some of the company's 150 lenders worldwide. But will that be enough to help stop the company's mounting problems? I'm Bruce Whitfield. This is Taking Stock, and we're looking at some of the big issues in markets with the chief executive of Vestact, Theron, and Mduduzi Luthuli from Luthuli Capital. I mean, just what a great sense of well-being we had in the first quarter of this year, and markets just didn't play along. Mduduzi, stronger rand, took everything from British American tobacco to Richemont, and particularly Naspers, and pull down the averages of the overall market. But at least the economy's in repair mode, I suppose.
Yeah, I mean, at least that's the message we're being told. Definitely sentiment is a lot better. People feel a lot more confident about the year ahead. First quarter was horrific, a bit of a perfect storm, if you can put it that way. But for a lot of people that have been looking at the market, they felt that the valuations have been high. So I guess the silver lining, if you look at it that way, or the bright side, is this presents an entry point because it's brought those valuations back.
You see, ever the optimist. Theron, I mean, the Standard Bank trading update, which they issued because of regulations in China, they've got a big shareholder, an ICBC, biggest bank in the world, owns 20% of Standard Bank. And to sum up what they were saying in their recent trading update was essentially, look, the economy is looking much better. The prospects are much brighter, but this first quarter of 2018 was far from advantageous in terms of actually growing profits.
Yes, in other words, we didn't go down the garbage chute. The country isn't finished. Things could come right. There are problems, though, lots of problems, and lots of corporate disappointments in the mix. So markets haven't been particularly helpful. But remember, it also follows a global trend where global markets peaked at the end of January in the US, and since then have been much more volatile and much more risky to the downside, and there's a lot of noise, I would say, at the moment.
The thing that's worrying most investors, Mduduzi, is the Treasury rate. This is the rate in the United States of which indicates what's going to happen to interest rates. And it's gone for the first time since 2013, end of 2013, early 2014, to 3%. US Treasury is rising to 3%. The strongest indicator of inflation returning after a 10-year holiday, which means interest rates in the US go up. And that creates a new interesting dynamic.
It does, because, I mean, we've seen globally there's a lot of volatility and risk in the markets. And for those investors who would look to cash out, pull in some profits and look towards bonds, take advantage of those interest rate, possible interest rate hikes in the UK, well, that means that's bad news for equity markets, basically. And it means a continuation of this trend that we've seen in the first quarter. But it's a bit tough because we're in an industry where we're always forced to predict going forward. We're looking for indicators, but we don't know. Especially, you know, one of the main drivers, if we're looking at possible inflation returning to the US market, is wage inflation, and those numbers haven't stacked up. And it also speaks to a changing economy, because a lot of the jobs that the US is creating are sort of your Uber jobs, which you're creating a lot of employment, but you're not creating a lot of wage inflation. And a lot of the indicators that we look for to guide us going forward are sort of not telling us the whole story, if you can put it that way.
Lots of ifs, buts and maybes, and that's the trouble for most of us, Theron, sitting on the outside of financial markets, is they're a scary place. The world is a scary place, so I'm going to put my money under the mattress or into my bank account rather than risk putting it into the scary world that Mduduzi is painting, because I may lose my money. Do you still operate on the basis of just choose great companies, put your money into them when the price is right, and forget about it? Or do we need to be more circumspect right now about the state of the world?
No, I think you always have to put money to work, because it doesn't help to have it in a boring bank account where it earns next to nothing. Look, that US thing, the Republican Party under Trump have done something really dirty and dastardly. They have basically written a budget which throws away all pretense of fiscal rectitude. The Republicans have put a budget in which is going to result in the fiscal train wreck in the US because they have increased military spending and they've cut taxes. And all that's going to happen is they're going to run massive deficits. So that's why the bond rate, in my view, has risen to 3%.
So it's not to do with economic activity, it's due to a policy shift.
I'm not quite sure what the long-term impact on economic activity is going to be. Well, what I can tell you is the tax cuts have been massively favorable for US corporations. So one of the best trades, in my view, right now is to buy US equities, because as a foreigner, a non-American that is, you can buy US equities, benefit from those lower tax rates and rising share prices and rising profits, and you don't have to worry about the fact that the economy might end up in dire straits.
But how much longer do those shares keep going up in the way that they have been for the last 5 years in anticipation of interest rates staying low? Because when rates do go up, and they have to go up at some point, that's bad for markets. That starts to weigh on those returns.
That's a very unpleasant question.
It's an unpleasant question, but it is the brutal reality. That may be 2, 3 or 5 years away, and that's the point we don't know. That's Mduduzi's concern there.
Yeah. Also, I think the other thing is we're sort of in no man's territory, where all the things that we've looked at in the past to give us some sort of direction and indication of what will the markets do, what does the bond market do, equities, property, etc. You just don't know where to go at the moment. You're sort of in what they call a Tina market. There is no a Tina market.
Tina.
There is no.
Which Tina is this? Constant Tina?
As in, there is no alternative, because essentially you don't want to be you don't want to be in the bank, especially if you're a long-term investor. And as an investor, you're always looking for yield. But at the moment, that yield comes with one can say unacceptable risk. You know,
unacceptable risk. So if that risk is unacceptable, then where do you put the money?
Look, I think you've got to be careful being in sort of parts of the market where the economy is very competitive, like consumer, discretionary, you know, like people that make toothpaste and hair care products and food all seem to be in dire straits. Retail is doing badly around the world. But the exciting parts of the market are where the puck is going. So I still think you want to be in some of these transformative tech industries. You want to be in healthcare. You want to look for companies that can really knock the skin off the ball, even if the economy is a bit wobbly.
Okay, those are often harder than to find, simply because the rest of the market is looking for precisely those sorts of opportunities. More on this conversation, particularly Steinhoff. Now, Steinhoff has been in the news for the last 6 months for all of the wrong reasons. It was all going swimmingly till the end of November, and then suddenly they couldn't put out those results. They've had an annual general meeting recently at which they failed to produce financial results. They've seen directors leave the company. They've seen other directors holding on by the skin of their teeth to try and turn this business around. Not much value in the company and a huge debt burden. How should you behave in South Africa with Steinhoff, which used to be such an important part of investment portfolios, plus your pension? After this break.